All right, let's get started. So officially, we're back on campus next week. So it should be interesting. We have a department meeting tomorrow at noon, so I'll see what they're all saying about that. My intent is to continue recording the classes synchronous in addition to the live class. And I'll give details in my email tomorrow about exactly how to set it up. I want to hear what the other professors are doing. So, and this class is different because, you know, it's 9 p.m. to 10:15 p.m., which I think is pretty crazy to start with. Whoever came up with the idea of having class until 10:15 p.m. Doesn't realize professors are 58 years old. So it is pretty late, but we'll make it work, and I'll be somewhat flexible, although, you know, I got to see what the official UTSA is. So we'll get that more detail. What we want to do tonight is we've done a good job of getting through the materials so far on schedule. We spent a lot of time talking about paper one. So we'll do that again. If you look on the syllabus, we're going to have a paper one discussion, maybe in smaller groups or something. We'll see how we work it up. It might be the whole class, but we'll have one last touch point on paper one where you'll have your draft and we'll talk through your drafts in a class. So we'll do that the week that the papers due. So I won't talk about your papers again unless you call me to ask questions. So what we're going to do tonight is, this is one of the exam questions on the first exam, is the ethical issues in the life insurance industry, at least from my perspective, and there's others that definitely I can show you that have a similar view. This is an unusual industry. It's unique in the way its distribution system is set up, so it makes it a very powerful sales force, but also a sales force that has some incentives that are a little questionable. So I want to walk through this question. I don't have it fleshed out in the notes, so you've got to take really good notes now. I'm going to say a lot of this that's not actually written in the notes, so you need to flesh it out, have more discussions. So if I'm going too fast, ask me to stop so you can finish writing or typing or whatever you're doing so you can get this. So I like these type of essay questions where you've got to put it into your own words rather than me just typing the answer out for you. I do have it organized in an outline, but I don't have the details. So you've got to get the details as we talk through it. But the first part of this question is setting up, how do we get here? So you've got to do something from the standpoint of, this industry hasn't always been like this, but it is now. So how did we get to this point? And really the late 1970s and the 1980s changed everything for this industry. This used to be a very boring industry. It sold term life insurance, whole life insurance. That was pretty much it. Two products, term life insurance and whole life insurance. Two very boring products. People bought it because they needed life insurance. And it was just going along, not a fast growing industry, a big industry, but not fast growing, not very exciting. And then the 1970s came along, and y'all don't remember the 1970s, you weren't alive, but there were those of us alive in the 70s. And very unique decade, high inflation, really high interest rates. And so when you think about this product, the term life was fine, but most insurance companies, they don't sell that much term. They don't make that much money off of term. It's a fairly basic product. They make a lot more money off of their whole life insurance, and we'll talk more about whole life here. And what they discovered with whole life is these whole life policies were paying these really low rates. So with whole life insurance, or any cash value insurance, you're buying insurance, but you also have this savings account. And the savings account has a lot of tax advantages, but the biggest advantage of life insurance is when the person dies, the estate gets the money tax-free, which is a huge advantage for life insurance. But it does have an investment return component to it. Well, in the 70s, whole life insurance was paying interest rates like 3%. And you could buy CDs, bank CDs paying 15%. When I graduated from college, I had a CD that matured and it was going to roll over at 15%. And I said, I don't want 15%. I can do better than that. That's how high interest rates work. And so interest are really high. So think about what happens. You got this product that's crediting interest at 3% based on the product itself. The product actually has that in the contract. You can't pay more if you wanted to. So 3% is what the product pays. You're paying 3%. The person has the product. Let's say they've got a cash value of $50,000. So maybe it's a $150,000 life insurance policy. So if the person dies, their estate gets $150,000, but they also have this savings element that's built up to $50,000. They can borrow that $50,000 at any time, and they can borrow it at 3%. And people weren't stupid. You can borrow money at 3% from your life insurance company. You can invest it at 15% in a bank CD. You're going to do that all day long. Why wouldn't you do that? And if you die, yeah, your insurance company is going to pay the $150,000 minus what you borrowed. So they're going to pay you $100,000, but your estate gets your $50,000 from your bank CD that was paying 15%. So you're going to come out ahead no matter what. And so what people were doing was keeping their whole life insurance, but borrowing most of the cash value and investing at much higher rates. So what was happening is all this money was coming out of life insurance companies and going over the banks. And that's called disintermediation. Disintermediation is when money leaves one intermediary, like a bank or an insurance company or an investment firm, and goes to another one. So there was two of them that happened. The first one was interest rate driven. People were taking money out of life insurance companies and moving them to banks, and life insurance companies were just losing a lot of money. I mean, when you have to sell bonds to fund these withdrawals, and you have to sell those bonds when interest rates are high, you're losing all this money on the bonds. It was a disaster for the insurance industry. So yeah, it was just crazy time for insurance industry. So this nice, boring product wasn't so boring anymore. Their customers figured out a way to take advantage of the insurance company. The second thing that happened was in the 80s, we came out of these two recessions in the early 80s, and suddenly the stock market took off. And that's when 401k plans took off and mutual funds took off. And suddenly people were saying, you know what, I'm making 3% on this life insurance policy. I can make 8, 9, 10% in the stock market. So again, they were taking their money out of life insurance companies and moving them to investment firms. So the insurance industry is sitting there going, okay, all this moving money is leaving us and going to these other two industries. What do we do? How do we compete? All right, so you see the process. Two massive things happen at once: high interest rates and the stock market starts taking off. You have this boring product called whole life, and people don't want that product. They want something exciting. So there's a setup. All right. So the industry had a choice to make. The first thing they could have done was just shrink. They can say, you know what, our product's not that central anymore. It's a dull product. It just doesn't make sense in this market. We're just going to shrink. And that's what most industries would have done. Their product went out of favor. There's all these other industries taking off. Let's get out of that market. Or maybe our insurance company gets bought by a bank and we keep the product, but this nice, boring product, that's probably what should have happened. The industry had tremendous excess capacity. There were too many life insurers in the business. They should have just shrunk. But they said, you know what? We don't want to shrink. We want to stay big. Not only that, but we don't like life insurance either. We kind of like this investment industry. We want to be asset gatherers. We don't want to be insurance salespeople. We want to be investment firms. And so how do they respond to the overcapacity? They responded by radically changing the industry. They said, we are no longer insurers. We are now asset gatherers. Now we're now investment firms. But then they said, you know what, though, we got a problem here. And this letter C is really important, not the step on the toes of you actuary majors, but life insurance companies have a huge disadvantage to banks and investment firms. And it's because life insurance companies have expenses those other two firms do not have. Actuaries are expensive employees. Banks don't have actuaries. Investment firms don't have actuaries. But life insurance companies have these massive departments of actuaries that greatly increases their expenses. So life insurance companies have higher expenses than banks and investment firms. How in the world are you can compete when your expenses are higher? And this is a key term right here. You do it by making your product so complex, your customers don't know your expenses are higher. This is what we call asymmetry of information. Now, all of this fits together. It's because of the type of sales force insurance companies have that allows them to get away with this. Banks and investment firms couldn't do this. They don't have the sales force life insurance companies do. So the industry said, we're not shrinking. In fact, not only are we not shrinking, we're actually going to grow in this environment. We're going to pick up a lot of the assets that the investment firms and banks are picking up right now. We're going to have products that have high interest rate crediting rates. We're going to have products that invest in the stock market. We're going to do just like all these other companies do, but we can't do it as competitively as they can because we're very expensive. But if we can hide behind product complexity, then we might be able to get away with it. That's essentially what they did. They combined that complexity with the hard sell. That's the other thing this industry has that banks and investment firms don't have. The life insurance industry has tremendously powerful sales representatives that are really well incentivized to push the products of this industry. I don't know how many of your uncles are bank CD salespeople. They go door to door selling bank CDs. I bet you've never seen that in your life, but you may have some people in your family that sell life insurance and they're very good at what they do. They know exactly how to say the right kind of things that get you to buy those products. So it's a very effective sales force, but they're expensive. Their actuaries are expensive. Their sales reps are expensive. A lot of them are getting paid commissions, which is a huge expense. So how does the industry survive when they're more expensive than all their competitors? So you make sure you incentivize the sales force that you have that your competitors don't have. You incentivize them to do the hard sell. And how do you do that? You do sales commissions. You pay them huge commissions. And that gets them, they sell very, very well. I'm going to argue, and some of y'all are going to disagree with me on this. I'm going to argue anytime there's a commission, you're creating a very serious conflict of interest. Anytime you tell someone, if you sell product A, your commission is $500. You sell product B, your commission is $50. And make sure you sell the right product to the right customer. If they can make any argument that A is the better product, they're going to sell A because they have families to feed. So there's this conflict of interest. Now, most life insurance companies say, no, but we train our employees to make sure they're selling the right product to the right people. I'm going to still say when you get paid 10 times more for selling product A than product B, you're going to have a tough time overcoming that conflict of interest. I'm in the camp that does not believe life insurance should have commission sales, but most of the industry does. That was my debate with the lady from Northwestern Mutual. I know we train our employees. They make sure they do what's right. Well, I still think it's a hard thing to overcome. And then you have the sales practices. Not only do you have these commissioned sales reps, but they're usually one-on-one with their customer. And I have sat through some of these sales pitches. And there are some pretty unethical companies out there. I won't mention the names of them, although one of them we're about to talk about here. I'll try not to give it away. There's a firm out there that has an incredible sales force, and the things they say behind the doors. My brother got sold by one of these companies, and he invited me to the sales pitch, and I was absolutely blown away with what they were telling him. I might tell you some of the stuff they told him. It's just absolutely unethical what they were telling him. But they're not recorded. There's no one there. There's no regulator there listening to them. They certainly have rules that they're supposed to follow. I think this particular sales pitch I heard was violating quite a few rules. There were some things they were saying that I really questioned if they were legal or not. They actually made me really, really mad, and I think they could tell they made me mad. My brother was like, calm down, calm down. But yeah, I was quite outraged. So that's the other thing is the sales thing is going on in someone's living room without anyone there watching. And there's definitely ethical firms, but there's other firms out there who knows what they're telling these customers. And then how are they trained? What is the company actually telling the sales reps? Some of y'all have been through, Northwestern Mutual is interesting. Some of y'all may have actually been through their process. I was talking to someone the other day about that, going through that process. And I was asking them, how much do they talk about make sure you sell the right product to the right people? And they said, no, they were all about finding leads, find sales lead. How do you find leads? How do you find leads? That was all about finding people to sell insurance to, not about the ethical side of it. Now, maybe that comes later, but the process they were in is all about finding people to buy life insurance. So what do you focus on? What are these firms? We're going to talk about that, especially when we get to equity linked annuities and how the employees are trained to sell that. But we're going to see with these new products coming around, the training and the sales practices have changed radically. Let me give you one good example so you see where I'm going on this. We're going to talk about universal life insurance. It's a product I used to be okay with, and now I do not like at all. And I'll show you why, my own personal experience with one. But when universal life came out, the marketing brochure changed dramatically. I remember where I worked, the marketing brochure, it was this pamphlet, and the front of it had this huge percentage on it, 7%. That was a new phenomenon for the insurance industry. The insurance industry never sold on rates before. When they sold whole life, they didn't put out pamphlets that said 3%. That's not the way they sold the product. And suddenly they have this product where they're advertising based on what interest rate they're paying. It's starting, you see how it's starting, their product started looking more and more like investments and less like insurance. And that all happened in the early 80s. It was quite a shift in the industry's focus. Right. So the industry has too much capacity, but they still want to compete. Not only do they want to compete, but they want to be good at it. They want to gather assets. They have a huge disadvantage that their cost structure is much higher than the competitors, but they got a sales force that is second to none. They have an advantage where they can sell stuff no one else can sell because of the sales force that's incentivized to sell hard. And they can get away with it because their products are so complex, it's really hard for the customer to really understand. And here's probably my most important one. Comparison shopping. These products got so complex that the word difficult is not even correct. I think the word is impossible. These products got so complex that they were impossible to compare one company versus another. We'll talk about this more when we get into some of these products. We're going to read an article on equity-linked annuities, and I think you'll agree with me. These products are beyond the comprehensive of 99.999% of the American population. This is just not a product that you can understand. And here's my argument. Some of you are going to strongly disagree with me on this. My argument is you should never buy a product when it's impossible to compare it to a product of another company. If you can't sit side by side and compare the product to another company, it's not good. So if you're buying auto insurance, not very difficult to compare State Farm, the UTSA, the Farmers on auto insurance. Not very difficult at all. If you're buying homeowners insurance, very easy to compare. If you're buying health insurance, it's not that difficult to compare one product versus another. I know there's a lot of pieces with deductibles and all that, but you can sit down and get a pretty good sense of which one's the better product. For term life insurance, very, very easy to compare one product of one company versus another. But universal life, variable universal life, equity-linked annuities, it is, I think Albert Einstein himself complained about how complex some of these things were. You know, these products can get extremely, extremely complicated. And I believe that there are products sold by the life insurance industry where it is actually mathematically impossible to compare the two products. To really compare the two products, you would have to set up a model, a stochastic model, and you'd run 1,000 simulations, and you'd have to compare the distribution of the different simulations. Even then, you can't really be sure. But we'll get into more of that. So these products are almost impossible. Now, if you're buying a bank CD, how hard is that to compare? One bank's paying 5%, one bank's paying 4%. They're both FDIC insured. Pretty easy. Buy the one with the higher rate. Not that difficult. Now, I know mutual funds are hard to compare, but they're not as difficult as life insurance. You got two mutual funds and they have similar historical performance. One charges 0.2%, one charges 0.4%. You know, take the one that has a lower fee. So it is easier to compare mutual funds than it is to compare life insurance. And we talked the information asymmetry there. Well, the sales rep knows a lot more about the product than the person buying it. And so that gives them a huge advantage. This is one of the ways economies work, is the buyer and seller should have equal power, equal knowledge, so that they can actually compete with each other. You know, when I go to buy a car, I feel like I'm at a huge disadvantage because I don't know that much about cars and how car dealerships do things. I feel like I have a huge disadvantage. So I don't like that. If I go to Men's Warehouse, I don't feel so disadvantaged. Their sales reps are really incentivized with commissions, but buying a tie or a shirt, yeah, I can handle that. That's not all that complicated. But there's certain products, boy, I don't like that car dealerships have heavy commissions because they have this information advantage over me. They understand. And it's not just their information advantage over the knowledge of the car, but their knowledge of how the whole process works, the whole sales process works. How much did the car cost? What's the markup on it? How much is their commission taking out of that? How much negotiating room do they really have? They know all of that, and I don't. So guess where I bought my last car? From Carvana, right? You know, no haggling, just go buy the car. Could I gotten a better deal somewhere else? Yeah, probably so, but I don't want to deal with that. Well, life insurance, you take that and you just multiply it by 1,000. It's really a huge disadvantage to the retail buyer. And then here, this is another, boy, this is one of my biggest pet peeves. Boy, I'm saying that on almost every one of them, aren't I? Life insurance, one huge advantage life insurance has over banks and over investment firms is the IRS, it's the tax. Life insurance has huge tax advantages, and probably to the nature that it probably does offset the expense disadvantage. So there are products that are, you know, life insurance, when you die, your estate gets all that money tax-free. That's a huge advantage over a bank CD. You know, if someone dies, their estate gets their bank CD, but you got to pay tax on the gain on that CD or the investments. You got to pay tax on that. But life insurance, even if you only paid a $50 premium and you die and your family gets $500,000, it all comes tax-free. That's a huge advantage. Life insurance also gives you tax deference that other products cannot give you. I mean, you can do an IRA at a bank, you can do an IRA at an investment firm, but life insurance companies can do even more than that. They can defer a whole lot more tax than those companies can. In fact, I think if they change the IRS rules, you might see the life insurance industry shrink like 60, 70%, because that's a huge advantage that they have. But here's what I disagree, and I really want you to get this in your paper because I want you noticing this anytime you deal with a life insurance company. When life insurance companies sell their products, they make a big deal about that tax benefit. But then when the product blows up, they say, we don't give tax advice. Go consult your tax attorney. I think that's incredibly unethical. If they're going to tell you to consult your tax attorney 5 years later, They need to tell you up front that you need a tax attorney to buy this product. What would happen to some of these complicated products if they told you you need your own tax attorney to do this product? They probably wouldn't sell as much, right? You'd probably scare some people off. And I'll tell you the Danya story and how that actually happened. So they push the tax advantages when they sell the product, and then when the product blows up, they say, "Hey, we can't help you. We don't give tax advice. Consult your attorney." That to me is unethical. They shouldn't do that. So the bottom line comes down is this product with all its complexity really better than products that are less complex? We're going to get into this in detail when we look at the equity linked annuity. I'm actually going to show you some charts, even though the article I'm going to use is a few years old. I think it still applies today. And that gets down to this last one. A lot of students on their exam don't really explain this very well. What do I mean by stochastic dominance? I don't know if you actuaries, if y'all use the term stochastic dominance, if y'all have heard that before. Man, nobody's on video. I'm never going to learn who y'all are. Sergio's on video, but I already know Sergio. I already know Jackie. So, so y'all know the word stochastic? So you're doing some kind of Monte Carlo simulation. You're doing simulations. That's what stochastic is. Stochastic is simulation, but with well-defined distributions behind it. So actuaries do a lot of stochastic modeling. In fact, all you actuaries, you probably have to take a class on stochastics. It's probably one of the required classes for your graduation. So it's simulation. So what does stochastic dominance mean? What we mean here, and we're going to see this especially with the equity-linked annuities, you run 1,000 simulations and the simple products win like 98% of the time, and the complicated product only wins about 2% of the time. And when the complicated product wins, it only wins by a little bit. That's exactly what we're going to see with equity-linked annuities. They're dominated by the simpler products by the overwhelming majority of the time. And when they do win, they don't win by much. When they lose by a bunch. But when they win by very little, and they don't win by much. That's called stochastic dominance. It doesn't mean the simpler products win 100% of the time, but they win by such an overwhelming majority of the time that it just makes more sense to buy the simpler product and not the more complicated product. All right, y'all see what I mean by stochastic modeling? When you look at the full distribution of what could happen, the simpler product just dominates the distributions. All right, so can y'all put that into your own words? Let me tell you Danya's story because it kind of has it all there in one story. If you read my blog, I tell the Danya story. But I do a lot of pro bono. At my church, I get calls, and there's someone who has had a financial problem, and they want me to help them out. And usually it involves a life insurance company. And so my pastor called me and said, Danya needs your help. I didn't know Danya, but I meet her. She's this 70-year-old lady, sweetest lady in the world. Just tell you her story. This is a lady, she gets married, she has a son, and right after her son is born, her husband tragically passes away. She has very limited education, maybe high school education, doesn't really have skills. So here she is, a single mother. She never remarries, single mother, limited skills, and she works hard. I don't know how she does it. She's such a sweet lady. I could see people hiring her just because she's just a nice person, not technical skills, but somehow over her life, she's saved up over $100,000, which I think is really impressive. And this life insurance person comes to her. I won't tell you which company, but it's a major life insurance company in the US, out of New York, but its company name doesn't have the name New York in it. And it doesn't start with an N, so haven't guessed it yet. And they get their hands on all of her money. So what do they sell her? Well, the first thing they sell her is a deferred annuity. And this company actually has pretty decent deferred annuities, and that was probably a pretty good deal. A deferred annuity is like buying a bond, and it just pays you interest, and it's tax deferred, so it's a pretty good deal. So that wasn't a bad product. They also sold her universal life. That made no sense at all. She had no dependents. She didn't have an estate. They sold her a very expensive product, but she had a universal life policy. But they sold her that product I didn't agree with. But this is what happened. When you buy a deferred annuity, you get all this wonderful tax deferral, but the IRS says, you know what, you can't defer that tax forever. At some point, you got to start paying tax. So when you turn 70, you have to start taking money out of that annuity and pay tax on it. What the IRS does is they say, okay, Danya, you're 70 years old. Your life expectancy is 85. So you got $100,000 in this product. We'll take $100,000, divide by 15 because you have 15 years left. You need to take 1/15 that money out every year. And then the next year they do it again. And they say, well, now your life expectancy is 16 years. So you need to take 1/16 of what's left. So she needs to take 1/15 out, and she doesn't pay tax on the entire 1/15. She only pays tax on the interest she earned on that 1/15. So this is a lady who has never paid tax. She has such a low income. That's how I don't know how she saved up $100,000. She had very little income. She's never paid tax. So in this annuity, she's going to have to take 1/15 out. She's probably going to have to pay a few $100s in tax. All right. So that's what her agent should have done. He should have annuitized her annuity, have her take a little bit of out, whatever law required. She should have paid tax on that. So she goes to him and says, what I need to do. Guess what he does? He takes her annuity and he surrenders the entire thing. So 100% comes taxable, which means this lady who's never paid any tax, hardly ever, she now owes the IRS $10,000. And she's in tears. How do I pay tax? So she goes to her agent again. So he surrenders some of her life insurance, which creates, guess what? More taxes. So now she owes all this in tax. What should he have done? He should have just annuitized her annuity and paid a small tax on that. But he surrendered the entire thing. And he puts it over into another annuity. He could have just left it in an annuity. Now, guess what he gets when he surrendered her annuity and put it into a new annuity? You may want to guess what he got out of that? A nice little commission, right? So she's in tears. What'd I do wrong? She wanted to go visit her son. He lived in Hawaii. She had this trip all lined up, but she was going to cancel that entire trip because of this tax. Her son ended up dying from cancer a few years later. So you can imagine. Now, she didn't know that at the time, but you can just imagine. So I go with her to meet with her agent. And her agent, now I'm very intimidating when I want to be. Y'all probably can't believe that. I seem like such a nice guy. But if I want to be intimidated, so I go in there, I'm going to scare this guy to death. And I do. This guy is shaking. He's physically shaking because I'm there. And he says in front of me, my company, I almost said the name of the company. He says, it's my company's fault. They didn't train me correctly. If they had trained me correctly, I wouldn't have done that. He says that in front of me. And so I said, okay, so it's your company's fault. Yeah, it's not my fault. It's my company's fault. Now, I was teaching a financial planning class at the time, and I told that class, these were people with years of experience as financial planners. And they said, he's lying. There's no way he didn't know how to do that. The guy had been in the business for decades. How could he not know that? He's lying when he says it's his company's fault. But he told me it was his company's fault. I did which is what you should all do. I wrote a letter to the CEO of the company. It was like 5 or 6 pages long, explaining everything that went on, including the life insurance they sold her that I didn't think that she needed. They did nothing with that letter, so I called them, and they said, well, we usually ignore the first letter, so send it again. So I mailed it again. The second time, and the nice thing about a presidential complaint is these companies have presidential complaint departments. I don't know if Cameron State Farm has one. State Farm probably doesn't get as many complaints as this company I'm talking to is. So this lady calls me and they tell me, this is what she says. I'm not making this up. I had this thing memorized because I was so irately mad, but she tells me, we are going to send Danya a check for $10,000 plus extra. I actually asked for more. And she said, the only reason we're doing this is It's because he said we made a mistake with you sitting there. If he had not said that in front of you, we would not be doing this because we are not responsible for tax errors. They're essentially saying that was her fault for letting her agent do that to her. All right. I kid you not, I was sitting there on the phone and the guy who works for me, he's behind me and he types me an email. Ron, everybody, the entire Bay is looking at you right now. I was talking so loud. I was so irately mad, but I was screaming at this lady on the phone. I was really mad. I asked her if she would do this to her own grandmother. I was so lividly mad. But the only reason they're giving her money back is because this guy admitted he made a mistake. But to get her money back, she had to sign a form saying this firm made no mistakes on this product or anything else they've ever done. I didn't think she should have signed that. I wanted to sue this company. And she kept asking me, should I sign it or not? I'm like, I can't answer that question. So we went to, she didn't have any money. So we went to a pro bono lawyer, and, you know, life insurance companies and lawyers, guess what the lawyer told her? He told her to hire a lawyer. I was like, thank you, pro bono lawyer. You're really helpful. So we're not going to do that. We're not going to hire a lawyer. I was tempted to give her the $10,000 out of my own pocket and to hire a lawyer, sue this company, and she got her money back. She could pay me back, and she could have I think she could have sued for a lot of money. I think what this company did was so egregious. Not just what they did on the annuity, but what they did on the life insurance as well. I really think, and this lady on the stand, this is your grandmother. This is the sweetest little, I think she baked me cookies when this was all over. She's just the sweetest lady. She would have been a wonderful person on the stand. I would have been pretty powerful on the stand because I would have testified what this guy said and would have known what he has said. So, okay, someone's putting on the chat and I was stepping on someone's feet. It wasn't one of those companies. I don't know if I'm going to tell you, Jesus, which company it was. If you worked one of those companies, it wasn't one of those companies. It is a company that was sued for hundreds of millions and lost on other products that I'll talk about later. But this is what this lady went through. She finally decided to sign this form because she wanted her money. She just wanted to be done with it. But she kept asking me, what should I do? What should I do? And I was like, I can't tell you that. I'm not a lawyer. I'm not going to give you legal advice. And we can't get legal advice. I wish it had happened a couple years later because there's a really famous personal injury lawyer in town with a very famous last name. And his daughter was in my class. And she was one of his lawyers. She took my class because she wanted to learn more about businesses so she could sue them better. I think we could have gotten her to take the case, but this happened a few years before that, so I kind of missed that opportunity. But this is what this industry was doing to this poor lady. And that to me is just, she trusted this company with her entire net worth. And they did well with her for the years that they bought this. Deferred annuity is probably a pretty decent product for her, but boy, they ripped her off at the end. And that was their argument is, Danya, we do not give tax advice. But she came to her agent and he did everything for her. So he was essentially giving her tax advice by executing this for her. It's just, by the way, he executed in a way that got him a commission and caused her $10,000 in taxes. So here's the question I ask you. What would Danya have done if I wasn't in the picture? Can you imagine this poor lady? She was in tears, literally in tears. She was so upset. And, you know, it's really sad. Then she loses her son. Now, her son actually visited San Antonio about a year later. And boy, he was in tears when he met me. He was like, I'm so glad she had you there, because I mean, she was just distraught about this. This is what this industry does to the Danyas of the world, at least this company. And this goes on all the time. I can tell you many other stories. There's another lady at my church who was, I mean, it was almost exact. I mean, just really scary. So with this going on behind the scenes, you know, it's an industry that certainly has some ethical issues. So Danya to me is kind of the poster child for this. Any questions on that? If any of y'all want to argue the other side that I got it all wrong, that you just found the one company that just one time did something wrong with everybody else. Now, one thing you can do, Jesus, you mentioned MetLife and Guardian. You can certainly go on Google and type MetLife I forgot the word. Lawsuit. I forgot the word. Class action lawsuit. So just Google that. Class action lawsuit in the name of your company, and all kinds of stuff will come up, especially related to the vanishing premium. We'll talk about that when we talk about universal life. But these companies are sued all the time. This summer, I was quoted in 2 articles because USAA got sued and lost their lawsuit on a class action lawsuit. Theirs was maybe pushing the envelope a little bit, wasn't nearly as bad as what we just showed here. USAA tends to be a little bit cleaner than some of the other companies, but the unique thing about USAA is they don't pay commissions. I do think that has some to do with the analysis, but even USAA has been sued. Most life insurance companies have been sued at some point because of the nature of these products. They're very complicated products, and their sales force is incentivized in a way that tends to get them in trouble. So if anyone wants to speak up and defend this industry, if you think I've overstated the argument, feel free to do it. I'm not saying all companies are bad. There are definitely some good life insurance companies out there. The good ones, I do think, have made mistakes. So that's only because when you have 40,000 employees, someone somewhere is going to do something wrong. I think probably, every major company has been sued in every industry for something. It's just the nature of being in a business. So what does that mean if you're an actuary? Well, what I tell students in finance, because I have a pretty negative view of finance, your first job, take your first job, learn the business, and then start asking about your company's products. Is this a company you can be proud of? If not, then make sure your second job is a company you're proud of, right? So it's hard to know when you first take a job if it's a company, has these type of ethical issues or not. But your second job, you don't want to have a company that when you tell them where you work, you normally grumble, you mumble so they don't hear what company you're working for. It's kind of like the guy who took my place at USAA. He came from AIG. In every interview, they asked, where did you work? I worked at AIG and it wasn't my fault. You don't want to work for a company where you have to say, I work for XYZ and it wasn't my fault. That's not a good company to work for. And life insurance companies can have those type of reputations. All right. So now your challenge is to put this into an exam question. So the way to ask the question is, and you'll see the question verbatim before the exam, is to discuss the ethical issues in the life insurance industry, including this entry section on the history, and discussing these ethical issues. And if you disagree with me, you can put into your answer, I disagree with the professor on this answer, but according to him, this is the way he set it up. All right. So if you work in this industry and you think I overstated it, you don't have to state it as your answer, but I want you to at least acknowledge that you saw the argument, my side of the argument. All right. And if you don't want to waste time on the exam, give me your side of the argument, then call me sometime and give me your side of the argument. We'll go out to lunch and you can give me your side of the argument. And if you convince me, I'll change my argument here. All right. Let me give you another example of this industry, though. Here's one. I don't know if y'all read this article, but this guy wins the lottery. He won $336 million in the lottery. This is several years ago. This is back in 2013, but even today, $336 million is a lot of money. So what did he do with it? He bought a $100 million life insurance policy. Now, who that has 360, well, obviously he didn't get that much money. He had to pay tax, but after tax, I don't know what he had, $200 million. Who that has $200 million buys life insurance? Now, could it make sense to buy life insurance? I might be able to make an argument that some life insurance might make sense. There is some life insurance, I'm maybe in a new, I'm not going to have that argument right now, but let's look at this product right now. So he's now suing his advisor who sold him the policy because not only did he buy his policy, but they also encouraged him to assume $10 million, tens of million dollars in debt. How in the world do you win the lottery and you end up buying a $100 million life insurance policy and you also borrow tens of millions of dollars? So his name's Kevin. He won the lottery in 2009. He took a lump sum payout, so he made $70 million after tax. So wow, he didn't end up with much, did he? I think that's a lot of these lotteries. It's $336 million, but it's like $10 million over the next 34 years. And when you take the present value of that net of tax, that ends up being $70 million. So he bought a $100 million policy when he had $70 million. They convinced him to buy 4 policies from 4 companies, telling him he could earn $50 million by the time he was 50 years old. Now, the agents made $1 million in commission, so they're pretty happy. That's a pretty good commission, isn't it? If you're a life insurance policy agent and you make $1 million on one sale, you're kind of happy. You know, they're probably sitting here in his living room trying not to giggle. Yeah, I've seen those cartoons where the dollar signs roll in their eyeballs. They probably literally were doing that and trying not to let them see it. I mean, this is kind of a nice little sell. He had no need for such life insurance. He stood no chance to benefit from the insurance financially since he was not a named beneficiary. I mean, it's kind of interesting. You're buying life insurance with your lottery. If you die, why do you need life insurance? You got $70 million. You'll be sending $70 million to your heirs. So it just doesn't make a lot of sense. Now, it's true. Your net worth is $70 million, but if you die, your heirs get $100 million, but you don't get any of that. That's kind of bizarre. 2 years later, he says the defendants attempted to persuade him to exchange his existing life insurance for a single $600 million policy. He learned that his existing policies were highly unsuitable for him and were funded in a way that he would provide him no potential benefit and would leave the trust liable for large amounts of gift tax. The claim says he finally surrendered the policies after paying $2 million in premiums. He's seeking damages. What did he end up with? So he made the same mistake. You see this with Tim Duncan. Tim Duncan made a mistake of thinking, I'm very rich. Obviously, I got to hire someone and pay them a lot of money, some financial advisor. And he made a mistake of thinking, if I have a lot of money, that means I can hire the best. And he made a mistake of thinking the best are the most expensive, where Tim Duncan could have called me. I would have done everything for him for free, and I would have put him in Vanguard funds, and he paid almost nothing, and he'd be tens of $millions richer today. That's the same mistake this person made. Now, how do you think these financial planners found Kevin?
Saw it on the news.
On the news. What do some of these lotteries have a requirement? If you win the lottery, you have to go on the news, right?
Right.
Because they want the advertising. There is no anonymity or whatever the word is, right? There are some, I don't know about this particular lottery. There are lotteries out there to say in the bylaws, if you win our lottery, you have to let your name get out there. You got to go on news. You got to advertise it. So they're going to find them. How many life insurance agents do you think are not ambulance chasers, but are lottery winner chasers? Yeah, it's kind of sad. So that's the other avenue. Another story I'll tell you, I had good friends doing pretty well, probably worth several $100,000, if not a few million, a real estate agents, really good real estate agent. I put him in the Vanguard. I said, just put your money in Vanguard. You'll be fine. Didn't hear from him for a few years. And then I went to his house and said, Ron, you see this great deal I got. And I'm going, uh-oh. I said, what'd you buy? He said, I got this annuity, and boy, it's great. He's explaining it to me and said, annuity, uh-oh, you're talking life insurance. Okay, what did you do? Why didn't you come to me first? You know, I'll work in this industry, but I didn't say all that. I'm just going, uh-oh, what mistake did you make? He starts explaining it to me. I'm going, boy, that's not an annuity. You bought life insurance. You didn't buy an annuity. He said, oh, no, it's this great annuity. It has all these tax advantages. He kept explaining and going, you bought an equity linked life insurance policy. He says, no, it's annuity. So I say, bring me the policy. He brings me the policy. He has an equity linked universal life insurance policy tied to 2 indices. This guy bought what might be possibly the most complicated product ever devised in the history of humanity. I don't know how, and this guy's pretty smart, but he had no clue what he bought. Not only that, he was not going to benefit from this at all. His wife was going to do pretty well if he died, but he wasn't going to benefit from it. I don't know why he bought this. He's buying life insurance, which means what? This is a guy in his 60s. That means he's buying life insurance premiums. What do you know about life insurance premiums when you're in the 60s? They're pretty high, right? They're thousands of dollars. This guy is spending thousands of dollars on life insurance. I didn't say anything to him. I was too embarrassed to say anything. I just said, yeah, that's a pretty complicated product. Good luck with that. That guy made a huge financial blunder. And boy, I don't know what he's doing now, if he got out of it. Now, how does his agent feel? Someone comes to you with a few $1 million and you got a 5% commission. His agent probably made $50,000, $100,000 off of that sale. That was a horrible purchase he made, just absolutely terrible. And this is a guy with a financial background. He's selling real estate. He's a smart guy. He's not stupid. His wife is very smart. She actually edits all of my blogs. Smart people, and they bought the worst thing they could have bought. You could have lined up 100 products. This would have been number 100 on my list of products as far as the worst thing you get to buy. So, now I could tell you in several more stories, but I'll stop there. Y'all get the picture, right? This is an industry that has some definite issues. All right, any more comments on that? Some of you are scared to say anything.
Yeah, I had a question. How exactly is it they disguise the product as like just deferred annuity and then it turns into life insurance? How do they not know they're invested in the life insurance?
Well, he was still pushing the life insurance benefits of it.
Oh, so he
But
knew
he
he was
pushed it.
buying life insurance.
My mom had the same problem when she bought a universal life and she kept telling me she bought an annuity. I go, Mom, that's not an annuity. There's no way that's an annuity. She says, no, it's annuity. But the reason she thought it was annuity is that the salesperson kept talking about what happened when my dad passed away. And she kept focusing on the settlement options. Like you can get this monthly income that lasts the rest of your life. Well, who cares about that? When you get the life insurance, you can do with it whatever you want to. But for some reason, her sales rep kept focusing on the settlement options. And so, yeah, my mom kept thinking she was buying universal life. And my mom's a very smart lady as well. The only thing she didn't do that was not smart was she didn't call her son to sit with her on this sales. She has a son working for our life insurance industry, knows these products very, very well. And she never talked to me because she didn't know what I did for a living. So it's not, so what did they actually say in the sales pitch? She actually kept the sales pitch. In fact, she has some documents from that sales that the lady left that she probably wasn't supposed to leave. And I've been really tempted to sue this life insurance company because it's a really bad product. But I can't find a lawyer to sue because my mom missed the lawsuit by about 10 years. The lawsuit was really a big thing about 10 years ago. So I'm having a tough time finding a lawyer to sue. But yeah, she didn't know what she bought. Now for him, don't you wish we had a video of that sales pitch? You could listen to the whole thing. And that would be really interesting to me. I'll tell you the sales pitch I have with my brother since we're talking. So Cameron, this was a company, my brother had a State Farm policy. This was a company coming in trying to get my brother to surrender his State Farm policy and buy theirs. He had a 10-year level term with State Farm. They wanted him to buy their 10-year level term policy. My brother's policy was a lot cheaper than theirs. So I'm like, why would you get out of one product from one company and buy the exact same product from another company when their premium's like 2 to 3 times more expensive? Right, here's the argument they made. And we're going to talk about this a little later. They said, well, the State Farm product is a participating product. And we have this article that says participating life insurance is a ripoff. What's participating policy mean? Well, what that means is if State Farm has some really good years, they can pay my brother a dividend and actually reduce the cost of the policy. If they don't have any good years, my brother just pays the premium. So my brother's worst case scenario is he'll pay that premium for the rest until he dies for 10 years. That's his worst case scenario. There's a chance he may get some extra money back if State Farm has some good years. the product this other company was selling, it had a fixed premium with no participation. So my brother could spend $50 a month at State Farm, but maybe it'd be less, or he could pay $150 a month for his other product, and it would always be $150. And they were telling him State Farm was ripping them off. It was a participating policy. Does that seem ethical to you? Would you rather pay $50 a month or maybe less, or $150 a month? That was a choice they gave him. The other thing they said is, you buy our life insurance and you can buy our mutual funds, and we'll put you into this mutual fund that's buys small stocks of small companies, and that's less risky than buying a bank CD. They actually told my brother that small cap stocks are less risky than bank CDs. I don't think that's legal for them to say that, but that's what they said. I don't know if Cameron's on this call, but the other thing they did is they showed this ratio that Standard & Poor's calculates, and their ratio was better than State Farm's. And they wanted to convince my brother that their company was financially more sound than State Farm's. But the reason their ratio was better is because all they sell is term. And when you sell term insurance, you need a higher ratio because you're a riskier company. And so I'll tell my brother, well, yeah, that's the Standard & Poor's ratio, but Standard & Poor's rate State Farm much higher than they rate this company. So the company that produced that ratio used that ratio and rated State Farm much higher than this company. So there's three things right there that these sales reps, and that was in a 45-minute sales pitch. Three things that they did were just completely outlandish. So yeah, these companies are, who knows what they're saying in the sales pitch. In fact, my high school government teacher was a terrible government teacher, but he sold life insurance for that company, and he was a really good life insurance salesman. He actually tried to sell his high school government class life insurance. These people are pretty aggressive. Some of these companies are pretty aggressive. All right, anything else? So I guess I can't answer your question there on how they did it. Yeah, unfortunately, my brother didn't switch from State Farm to this other company. We're going to talk in detail about this other company because they're quite famous, and you're going to see them coming up here at the end of this. All right, no other questions? Can y'all handle this first essay question? So you know what the question on the exam is. So try to organize your thoughts.
I was curious, like, if you don't really know much about life insurance, should you just get like the most basic plan? Like, would that be the safest bet rather than to like go down the sales pitch and everything like that?
Well, if you get married and you have kids, so you need life insurance, and you probably need a few $100,000, and the insurance, an agent will help you know how much to get. You can do that online if you want to. So financial planners do a great job of helping you budget, making sure you have the right auto insurance and all of that. The question is, are they getting any commissions or any kind of kickback that might sway their decision? But level term is my favorite. 20-year level term is a really good product. We're going to talk about it. What I love about 20-year level term is it gives you and we're going to talk quite a bit about this, Anthony. So it gives you the insurance you need when you need it. When you're young and you have kids and you're worried about, dying early, while your kids are still dependents. But the wonderful thing about 20-year level term is it's very easy to compare one product to another company. Like that State Farm product. It's a 10-year level term from company A or company B. State Farm charges $50. The other company charges $150. Pretty easy to make that decision. So it's when you get, and you get the whole life. Whole life is very easy to compare. One whole life is $500 a month. Another one's $400 a month. It's pretty straightforward. It's when you get into universal life and variable universal life and equity linked life. That's when it gets really complicated. And that's when I say, yeah, if you read my blog, I actually tell you what you do. And what you actually do is you go through every potential scenario with that product and try to figure out what's the best deal. But even there, you can't really tell, because with universal life, they can change their crediting rate any month they want to. They may be paying 4% this month. The next month they can start paying you 2%. So, it's really, really difficult. But with term life and whole life, there's a premium. It's set for the entire period. It can never change. So you just compare the premiums. It becomes a lot easier. So yeah, I think simple is better for most things. I agree that on the investment side. Going to Vanguard and buying an index fund, that's a lot simpler than trying to figure out if Fidelity is better than T. Rowe Price is better. Simple is usually better for most Americans. And that's not just me saying that. Warren Buffett says that. Charles Ellis says that. I've got some pretty impressive people in my camp on these arguments. So they're a lot smarter than I am, but at least I agree with them. So if you work for this industry, make sure you tell your parents that you do, so that they can come to you for help. Right? Or if your parents are dealing with these type of agents, make sure they go to Cameron or someone like that you can trust, and not going to someone that's getting, working for one of these fly-by-night companies. All right. Anything else on that? All right. So where we're going to go from here is we're going to start talking about the products. We're going to spend a few classes on life insurance. Then we're going to spend a few classes on annuity. And then we're going to spend a whole lot of classes on health insurance. Because health insurance, there's a lot we can talk about there. And then once we finish that, we'll get into the number crunching. There will be some number crunching on the annuities because we're going to do equity-linked annuities. I'm going to actually have you create an equity-linked annuity. So you can see how you can do it yourself without having to have a life insurance company do it for you. So you can save a lot of money. So that's the only math on the first exam is the equity-linked annuity. So the second exam has all the other quantitative. All right. So we're going to start with life insurance and just a little bit of introduction on life insurance. Life insurance is not insurance against dying because we're assuming 100% of people die. So life insurance is insurance against premature death, dying before you expected to. Unlike property insurance, there can only be one claim for life insurance. Now, has there ever been anyone out there who had two claims in their life for life insurance? Yeah, it probably has. And there's probably some stories out there. If someone goes missing for 7 years and it's pretty obvious they died, like maybe it's a hurricane or something, and it's pretty obvious they died, the life insurance will pay out after those 7 years as if they had died. And then 9 years later, they show up that they're actually alive. He could buy more life insurance to get two claims. That's an incredibly rare situation, right? There are stories of people who fake their death. There's a really, I don't know if y'all ever watched some of these online, these Netflix specials about these these actual real life murders. There's this one guy, he went out and he found someone who looked like him. And he was going to invite him over to his house and have him work in his car. And while he's working in his car, he was going to have the car following this guy's head. And because it looked like him, it was going to make him look like he died. And then he was going hiding. His wife was going to get the life insurance. But the last second, this guy decided not to do it. So he had to run out and buy someone else who kind of looked like him, but he didn't look enough like him. He wasn't tall enough. And so they figured out pretty quickly this wasn't this guy who died. So he killed this guy to get the life insurance, and they ended up arresting him. And that's what people do with life insurance. It's pretty amazing. So so there probably are some people who have gotten life insurance and got the paid out when they actually didn't die. But most people only get one claim on their life. Insurable interest is extremely important with life insurance for that very reason. We don't want people buying life insurance and then have an incentive to kill somebody. And so we want you to have insurable interest. What does that mean? We want you, when you buy life insurance on someone's life, we want you to prefer that they live and not die. We don't want the life insurance to be just enough to take their life. But there are a lot of people who have been killed for the life insurance, no doubt about it. So insurable interest is usually not an issue if you're insuring your own life. All right, so if you buy an insurance on your own life, they're not going to check on insurable interest. They just assume that you prefer to live. There's no legal limit on insurance. If you want to buy $1 billion of life insurance, you can, if you can afford it. You probably can't get it from one company, but if you want to buy $500,000 from 1,000 companies, you can do it. There's no law that keeps you from doing that. And they all have to pay out. However, the police are probably going to investigate. If you have $1 billion of life insurance, they're probably going to investigate that claim more carefully. If the insured and the policyholder are not the same person, then there's certain rules about insurable interests. So a husband has insurable interests in the life of the spouse, the wife has insurable interests on the husband. Children have insurable interests on parents, parents on children. So there are certain things that are just assumed to have insurable interests. However, they're going to want the consent of the person whose life is being insured. Now, there's one lady at my church, her husband set up the life insurance to essentially rip her off, but she had to sign the form, but she didn't understand what she was signing. And then they got divorced. And he set up the insurance, so if they ever got divorced, he would essentially steal all of her money from her. Pretty evil guy. But the lawyer for the divorce was so upset about it, he set it up so that because he set it up to have life insurance on his life, such that she wasn't the beneficiary. And he took all of her assets to buy the life insurance. But the lawyer was so upset about it that he actually changed that. So, I mean, this is pretty interesting for life insurance. You would think with life insurance, if a husband or a wife buys life insurance on her husband and then they divorce, you would assume the life insurance becomes illegal, but it doesn't. You can buy life insurance on someone and you can have a horrible divorce. The two people break up. They actually want each other dead, and you can keep that life insurance in force. So life insurance is kind of unusual like that. You can't do that with other insurance. If you have auto insurance on a car and you sell that that car to somebody else, you can't keep the auto insurance on that car. Once you sell the car, the auto insurance is gone. But with life insurance, insurable interest only has to be in place when you buy the insurance. It doesn't have to be in place anywhere, any other time. So it's pretty interesting stuff. So she actually had insurance on her husband after that terrible divorce. And then she tried to get out of it because she just didn't want it anymore. And in the middle of that, her insurance company kept messing up on the surrender. And in the middle of that, her ex-husband told her he had cancer. And so we said, well, we'll keep the insurance in force after that, because the insurance company kept messing up over and over and over. They messed up 3 different times. And so I told her, well, your husband has your ex-husband has cancer. And then she's like, well, I'm so guilty that I have insurance, and my husband, if he dies, I'll make all this money. I said, well, you shouldn't feel guilty. He treated you pretty horribly, but is an interesting person to deal with. But she had the right to have insurance on a man she was no longer married to. So it's interesting. Now, insurance has 2 big issues. One is anti-selection, and the other is moral hazard. Anti-selection or adverse selection means that the people who most likely are going to get an insurance claim are the ones who are going to buy it. Unhealthy people buy more life insurance than healthy people. Unhealthy people buy more health insurance than healthy people. So that's the anti-selection, adverse selection. So life insurance mortality tables, they adjust for that. They know that the people who are buying insurance are more likely to need it. And so the simple fact that you buy the insurance tells the insurance company you're riskier than average. And so you're going to pay more. So it's kind of a strange thing. They just know that. Same thing with an annuity. If you buy an annuity that's going to pay you for the rest of your life, they just know on average you're healthier than the average person. And so you're not going to get as good of a price as if you were on, they didn't know that. So that's adverse selection. Moral hazard is very, very different. Adverse selection is extremely important to life insurance, but not as important to property insurance. Moral hazard is extremely important to property insurance, but not so important to life insurance. So moral hazard is you buy the insurance, and just buying the insurance, you become more, you make yourself more risky. you start acting more risky. So a good example is you buy a car and you forgot to buy the auto insurance, and it's a $70,000 car. And you say, oh my word, I forgot to buy auto insurance. I don't have any auto insurance. You're probably going to drive that car home very, very carefully. You might even leave it at the dealer and let them take the risk. Go home, buy your auto insurance, and then go back and get the car. But as soon as you get that car, you'll start driving normally. And auto insurers know that. And so the fact that you buy auto insurance, that you become a riskier driver, so they charge you more. I don't think that works for life insurance. I don't think people say, you know what, I don't have any life insurance, so I'm not going to do any bungee jumping or skydiving. And then they buy life insurance. Oh, now I can do all the skydiving I want to do. I doubt that's the case, because you've got a lot of skin in the game with life insurance. Death is still a horrible thing. Whereas auto insurance, you know, your car gets wrecked, it's a car, you replace it. So moral hazard doesn't really apply to life insurance. We do debate later with health insurance. Does moral hazard affect health insurance? Are there people who act more risky just because they know they have health insurance? So they do bungee jumping and say, you know what, I'm okay, because if I break an arm or a leg, I have health insurance to cover it. I don't know. I think that's a little bit of a stretch. So life insurance is mainly focused on adverse selection, anti-selection. That unhealthy people tend to buy their products more often. Okay, types of life insurance, high level, there's just two of them. There's term insurance and there's permanent insurance. Term covers you for a specific amount of time. Perm covers you for your entire life. It also has what's called a cash value to it. It has a savings element. So there's two pieces of it. There's the insurance and there's a savings element. And what that means is, with the term, if you ever cancel the term policy, you walk away empty-handed. You have nothing. You lost whatever premiums you paid, you get nothing. But permanent insurance, if you decide you don't want the insurance anymore, you get whatever that savings element is. You get the cash back. All right? Permanent has whole life, endowment, universal life, adjustable life, variable life, equitable linked life. It has a bunch of different pieces. We'll talk through each one of these and how they're different. Term really is focused on how the premium's set and how long the term lasts. All right. Now, I don't know what the shortest term policy you can think of. It's less than a year. You can buy life insurance for less than a year. Everybody know what the absolute shortest term policy you could ever buy would be? Any guesses? Could you buy a one-day life insurance policy? Could you buy a 40-minute life insurance policy? So I'm going to say yes, you could buy a 40-minute. Where would you buy a 40-minute life insurance policy? Where would you be?
Dying on the side of the road or something.
No, not on the side of the road, but you are traveling, but you're not on the side of the road.
Airplane?
Airplane, flight insurance. You're flying from here to Dallas. Well, skydiving possibly, Corinne, that's a good answer. I've never skydived. Do they sell life insurance at the skydiving place? That kind of be a little nerve-wracking, wouldn't it? But if you fly from here to Dallas, you can buy flight insurance right there at the, you know, I don't know, I haven't seen it in a while, but they used to have these little kiosks where you buy flight insurance right there at the airport. So 40 minutes life insurance, skydiving, I guess, what's that, 5-minute life insurance? So it can be pretty short. The longest is maybe 30 years. You can buy a 30-year level term. All right, so we'll start there. We'll go with the life insurance this next class. Watch for my email tomorrow on how we're going to handle the in-class, in-person stuff. All right, I'm done.